Welcome to today's market report. European stocks slid on Thursday, tracking an overnight sell-off on Wall Street as a rapid rise in US inflation spooked investors, while a drop in commodity prices weighed on heavyweight miners. The pan-European STOXX 600 index fell 1.6%, drifting further away from an all-time high. Basic resources and oil and gas sectors among recent market leaders on the back of a surge in commodity prices fell about 3%. Automakers also shed more than 3%, while defensive names like healthcare and telecom posted small losses. The US benchmark S&P 500 stock index suffered its biggest one-day percentage drop since February on Wednesday, after a surge in April consumer prices raised concerns that the Federal Reserve would raise interest rates earlier than expected. The debate as to what the Fed will do will continue, and we've seen in terms of the market that after economic growth peaks, there tends to be a lull for 6 months or so. The returns are going to be modest at best over the next 6 months. Market could go sideways and there could be more volatility, according to RYCEY Wealth Management. European stocks have rallied to all-time highs this month, with the STOXX 600 up almost 10% so far this year, as the economic recovery prospects and strong earnings drew buyers of equities. British luxury brand Burberry tumbled 7.9% on reporting a 10% drop in annual sales, weighed down by the COVID-19 pandemic. UK's biggest broadband and mobile provider, BT Group, fell 4.8% as it reported a 7% fall in revenue and a 6% fall in adjusted earnings for the full year. Shares of Canadian chip company Alphawave plunged by as much as 18%. Among a few bright spots was Spanish telecoms group Telefónica, which rose 3.7% after it posted first quarter core earnings broadly in line with forecasts. US crude oil was down 3.3% at $63.97 per barrel. Brent was down minus 2.86% at $67.32 per barrel. Gold futures was up 0.15% at $1,825.25 per ounce. On the FX front, GBP/USD flirts with weekly lows near 140.50 as cable consolidates below 142.38 this year's high. Economists regard the pair as underpinning, while above the 137.74 uptrend and targets the 143.77 2018 high. The modest pullback in the US Treasury bond yields, along with a goodish rebound in the equity markets, held traders from placing aggressive bullish bets around the safe haven US dollar. On the other hand, the upbeat UK economic outlook continued acting as a tailwind for the British pound and helped limit losses for the GBP/USD pair. The US producer price index rose 0.6% in April, and the year rate surged to 6.2%, beating market expectations. Adding to this, core CPI also surpassed consensus estimates and came in at 0.7% month-on-month and 4.1% year-on-year, which fueled fears about runaway inflation, though did little to impress the US dollar bulls. From a technical perspective, the emergence of some dip buying near the 140 round figure warrants some caution for bearish traders. This makes it prudent to wait for some strong follow-through selling before confirming that the GBP/USD pair has topped out in the near term and positioning for any further depreciating move. Increasing volatility now prompts euro-dollar to fade in the initial uptick to levels just above 121 the figure, and a refocus on the 120.60 band ahead of the opening bell in Wall Street. On the other hand, the relentless vaccine rollout in the old continent continues to prop up growth prospects in the region, preventing at the same time a serious bearish move in the shared currency for the time being. Euro-dollar failed once again to surpass the 121.80 to 90 region so far this week, area coincident with a feeble level of the November to January rally. In spite of the ongoing USD-led knee-jerk, the sentiment around the single currency stays constructive on the back of the investors' shift to the improved growth outlook in the old continent, now that the vaccine campaign appears to have gained some serious pace and solid results from key fundamentals pari passu with the surging morale in the bloc. The US dollar was supported by concerns of an earlier than expected Federal Reserve response to inflationary pressures in the wake of worryingly large jump in US consumer prices. The dollar index was at 90.775, dollar yen was at 109.73. This is today's market news. Thanks for listening. We'll see you next time.